Nixon's temporary move away from gold reshaped the global economy, but the real story is about what came after. It's easy to look at today's economic mess: sky-high housing costs, wages that can't keep up with inflation, global debt levels that make your head spin, and point to a single moment in history as the culprit. For many people, that moment is August 15, 1971, when President Richard Nixon went on TV and temporarily ended the dollar's convertibility into gold. Spoiler alert, that temporary suspension was about as temporary as your friend who just needs to crash on your couch for a week. Since then, critics argue, money has become fake. Inequality has skyrocketed, and we've stumbled into a financialized economy where speculation matters more than production. The story practically tells itself. Once the dollar wasn't backed by gold, everything spiraled downhill. But is it really that simple? Let's dig in, because the truth is juicier and more complicated. To understand what happened in 1971, we have to rewind to 1944. The Second World War was winding down, and leaders from 44 nations met in Bretton Woods, New Hampshire, to figure out how to rebuild the global economy. The outcome was a financial architecture that tied other countries' currencies to the US dollar, and the dollar itself to gold. It wasn't a true gold standard. Ordinary Americans couldn't just walk into a bank and swap their dollars for gold. That privilege was reserved for other central banks. But the arrangement gave confidence to the world. Dollars were as good as gold, and gold was finite. So trade could flourish without the chaos of constantly fluctuating exchange rates. And flourish it did. With stable currencies, rising industrial output, and new technologies like container shipping, global commerce boomed. For a while, the system seemed unshakable. But beneath the surface, cracks were forming. Here's the thing about promising to redeem your dollars. For gold, you actually need to have enough gold to make good on that promise. By the late 1960s, the US didn't. Washington was spending heavily on the Vietnam War, on social programs, on Cold War competition, and printing more dollars than it had gold to back them. Most countries let it slide, content to hold dollars as reserves. But not Charles de Gaulle. The French president thought the US was abusing what he famously called its exorbitant privilege, the ability to pay for real goods and services with paper money everyone else treated as gold. So France started cashing in dollars for the real stuff. At one point, they even sent a battleship to New York Harbor to pick up their gold. It wasn't just France. Other countries joined the rush. Used gold reserves were bleeding away. Nixon had two choices: keep draining Fort Knox until it was empty, or slam the door shut. He chose the latter. On August 15, 1971, Nixon announced that the US would suspend temporarily the dollar's convertibility into gold. In practice, this killed the Bretton Woods system. The dollar became just another fiat currency backed not by shiny yellow metal, but by the full faith and credit of the United States government. Markets reacted with a mix of shock and relief. Stocks actually rallied at first, but the long-term consequences were huge. Gold prices skyrocketed by nearly 1,000% over the next decade. Oil producers, suddenly wary of trading black gold for green paper, jacked up their prices. Inflation surged. Ordinary people felt it at the gas pump, the grocery store, and in their paychecks that couldn't keep up. So yes, Nixon's decision mattered. But blaming all our modern problems on the end of Bretton Woods is like blaming all your hangovers on that one tequila shot you're ignoring the 6 beers and 3 whiskeys that came after. If you look closely at the scary economic charts, wages decoupling from productivity, inequality shooting up, the financial sector ballooning, you'll notice something interesting. The real inflection point isn't 1971. It's a decade later, in the early 1980s. That's when the US and the UK, under Thatcher, embraced a new economic playbook: deregulation, Tax cuts for the wealthy weakened unions, and a hands-off approach to monopolies. Suddenly, finance wasn't just a support service for the economy. It became the economy. Wall Street outgrew Main Street. The result? Asset prices soared, wages stagnated, and inequality widened dramatically. Billionaires multiplied. Workers got left behind. Housing shifted from being a basic necessity to an investment vehicle. The gold standard had little to do with this. It was political choices, not metallic reserves, that rewired the system. Let's be fair. Ditching gold wasn't all bad. In fact, it allowed economies to grow faster. Without gold as a constraint, governments had more flexibility to respond to crisis. When the 2008 financial crash hit, for example, central banks could print trillions to stabilize markets. Under a strict gold standard, that would have been impossible. But with freedom comes responsibility, and we haven't always used it wisely. Printing money is easy. Channeling that money into productive investments, like infrastructure, education, or clean energy, is harder. Instead, much of it has gone into asset bubbles, stock buybacks, and speculation. It's like giving a teenager a credit card with no limit. Sure, they'll survive, but you can bet they'll also rack up a few reckless charges. Unsurprisingly, gold bugs love the 1971 story. For them, it's Exhibit A in the case that fiat money is doomed. They argue that if we just stuck with gold, inflation wouldn't have eroded savings, inequality wouldn't have exploded, and money would still be real. There's some truth in the critique fiat money does make it easier for governments to overspend and inflate away value. But let's not romanticize the past. The gold standard had its own problems, including frequent depressions and currency crises. And today, even if the US wanted to return to gold, it simply doesn't have enough of the stuff. The global economy is too big, and America's gold reserves are nowhere near what's needed. Gold will always have a psychological allure. It's shiny, it's scarce, it doesn't rust. But it's not a magic bullet. If we zoom out, the big shift isn't about gold versus fiat. It's about the way we structure our economies. After World War II, the golden age of capitalism was built on rising wages, strong unions, expanding social programs, and tight regulation of finance. That era ended in the 1970s, not just because of Nixon, but because of oil shocks, conflation, and political backlash. What replaced it was neoliberalism, faith in free markets, skepticism of government, and an embrace of globalization. That shift delivered growth, yes, but also inequality and fragility. The winners' investors, corporations, the ultra-wealthy pulled way ahead. The losers' workers, renters, debtors were told to be grateful for cheaper TVs and faster iPhones. That's why charts of inequality look like hockey sticks starting around 1980. Not because the dollar lost its gold anchor, but because the rules of the game changed. Calls to return to the gold standard pop up every few years, usually during times of economic stress. But realistically, it's not happening. The global economy has outgrown gold. The US doesn't have enough reserves, and no other country is lining up to play along. The better question is, what do we do with the fiat system we've got? Do we regulate finance so it serves the real economy instead of siphoning wealth upward? Do we tax extreme fortunes and reinvest in public goods? Do we build a digital single market in Europe to compete with American tech giants? These are the debates that actually matter. Looking back, Nixon's 1971 decision was less of a clean break than a messy divorce. It ended a marriage of convenience between gold and the dollar. But the real drama came later, when policymakers in the 1980s restructured economies in ways that turbocharged inequality. Blaming it all on Nixon is too easy. The gold standard wasn't a paradise, and fiat money isn't a hellscape. Both are tools. The real issue is how we use them and whether we build systems that spread prosperity broadly or funnel it upward. So next time you see that infamous 1971 arrow on a chart, remember, history is rarely that tidy. Sometimes the turning point is less about the year and more about the choices we make afterward.